Hi guys, this is going to be an update on the Treasury bill, note, and bond video that I did earlier in the month. We've seen some big movement in US Treasury yields today. Look at this massive spike here in blue. Just since about 6:30 this morning, it went from roughly 4.15% all the way up to almost 4.3% yield. What was it that happened? It wasn't just the 10-year note that happened here either. In fact, there was a lot of big movement in the 2-year note and the 3-year note. Look at that. But even here at the 1-year Treasury bill, we're going to see some big movement, and the 6-month Treasury bill. What was it that was happening this morning? Well, the Consumer Price Index, the CPI report, came out this morning. What did the numbers look like that drove this massive spike in yields? Here are the numbers and the trend. The latest numbers that came in overall for January, 3.1%. Now this was greater than expected. Economists were estimating 2.9% on the headline or overall inflation. When it came in at the core, remember that's energy and food prices stripped out, the core came in at 3.9%. So this is far above what the Fed is looking to get us down to, that 2%. Now let's just take a look closer at this core inflation. Let me show you something interesting here. This is from the Bureau of Labor Statistics, their release of the data today. And if you look here, you'll notice that energy, so this is one of those things that gets stripped out here, food and energy. Notice how much energy is down. So when we look at all items less food and energy, which is up 3.9%, part of this, the reason it's only 3.9% is because energy prices have come down so much. But let me show you an interesting article that shows up in Barron's today. Keeping that decrease in energy prices that I just showed you, look at this headline here, energy deflation looks set to reverse. In the text here of this article, it says that energy prices fell 0.9% in January from December levels. Now that coincides with that bar graph that I showed you just a minute ago. But let's look closer at this text of the article. We'll see here that it says energy prices look poised to rebound going forward. It talks about the West Texas intermediate crude prices going up to $77 from $74 at the start of the month. The average gasoline price has gone up to $3.23. That's up from $3.07 a month ago. And it discusses that prices could keep rising as the refiners switch out from their winter blend of gas. Remember, in the United States, we changed the mixture of the gas there. We try to make it a little less polluting when it comes to the summer driving season when we're driving a lot more. So keep that in mind as that expensive summer blend comes up, gas prices may look to go even higher. What does that say potentially for February's CPI report that comes out in March? If these energy prices here start creeping up, we could expect that this core inflation here could go up significantly as well. So keep that in mind when you're thinking about your bond and Treasury bill purchases. I want to drill down into the data just a little bit more here. The Wall Street Journal has an interesting site where you can track graphically how items are moving month to month here. So this is for the latest data that just came out this morning. And if we click on each of these little boxes, we'll see again 3.1% for all items, 3.7% all items less energy. That's only stripping out energy and not food. And you can, again, kind of click on each of these and get an idea for just what it is that might be causing inflation to go up. So you'll notice that I stopped here on services, 4.9%. This is really the big driver for inflation right now. In fact, the cost of goods have been coming down, but services have been going up. Let's take a different way of looking at this. This is from the Bureau of Labor Statistics, and what they do is use these little bubbles here to give you an idea of the magnitude of different areas within our economy and their prices and how that affects inflation. And what do you see here as the biggest bubble? Services less energy. This one right here. This is the one, and relative importance, 60.899. So this big bubble here of services less energy services, this is what's driving inflation, at least for the month of January. Just in case you're curious, what are the orange dots here? The orange dots are these ones that have increased the highest in prices. This one here is frozen non-carbonated juices and drinks, up 29% year over year. We see one other really orange dot here, and this one is motor vehicle insurance, up almost 21% year over year. So what has today's data done for expectations that the Fed would be cutting rates anytime soon? For that answer, we're going to turn to the CME Group's CME Fed Watch tool. Looking here for the March meeting data, just take a peek here just to give you an idea of what these bars mean. The dark blue here is as of today. The lighter blue here is as of yesterday. This is 1 week ago, and this is 1 month ago. So 1 month ago, the probability that the Fed would hold rates steady was only less than 20%. Now, if we go to today's data, 91.5%. Let's take a look out into May. The probability now that the Fed would be holding rates steady at its current rate, yesterday was at 39%, and now today, just based on the CPI data, it's up to almost 63% chance that the Fed will still have today's current rates when they finish their meeting on May 1st. And just in case you're curious about June, yesterday it was a 7.8% chance that we would still have the same rates that we have today. That has now gone up to 27% chance just based on today's CPI data. Now, today's spike in this Treasury yield comes on the heels of a spike earlier in the month based on the jobs report. In fact, just looking at the 5-year note, it's gone from 3.8% before that jobs report came out, now up to 4.3%. That is a really big spike in yields over such a short period of time. I think this puts the Treasury in a little bit of a bind here. Why? I showed you this data earlier in the month. This is from the Treasury's quarterly refunding announcement. The Treasury has been keeping yields on the 10, 20, and 30-year Treasuries artificially low by keeping the auction sizes low. Let me show you what I'm talking about here. So you'll notice that in November of last year, they were doing $16 billion a month of 20-year Treasuries, and that is down to $13 billion a month is the expectation for April. So they're holding these longer terms down while they increase the sizes of these Treasury notes here. Look at the 2-year, $54 billion in November. That's going to go up to $69 billion in April. So they're shifting their Treasuries towards these shorter terms to keep the yields down on the longer term Treasury notes and bonds. So now this puts the Treasury in a little bit of a bind here because they've been keeping the auction size down, trying to keep the yields down, and the yields are just going up anyway. Additionally, there's one important part here that's going to keep the Treasury in a little bit of a bind. This document here comes from the Treasury Borrowing Advisory Committee's quarterly recommendations to the Treasury Department or to the Secretary of the Treasury. And there's an important paragraph in here that I want to show you. So in this, they consider the slowing or ending of the $60 billion monthly Treasury runoff. If you're not familiar with this, the Fed has purchased the Treasury's debt. In fact, they've purchased a lot of the Treasury's debt, but they've been letting this run off their balance sheet. The way they're doing that is they're just letting these bills, notes, and bonds reach their term, and then they're not buying new ones. So this puts extra pressure on the Treasury to sell their debt because the Fed's not buying their debt. And the Borrowing Advisory Committee says that they're reflecting investor expectations of the Fed's winding down the balance sheet reduction, leading to lower net issuance, meaning they won't have to issue as much to the public because they're thinking that the Fed is going to be starting to repurchase the Treasury's debt. However, with this economic data coming in, I think the chance that the Fed is going to stop their balance sheet runoff is really not even in the near future. They've been stating this when they get to the end of their FOMC meetings. There have been some members of the FOMC who have been at least mentioning balance sheet runoff, but really not giving any timetable for when that's going to begin. And I think the odds of this happening are getting put off further into the future as this economic data comes in that's spiking up all of these Treasury yields. So what do I see happening potentially in the next week when it comes to additional increases in Treasury yields? Well, on February 15th, the retail sales data will come in. And then on February 16th, we're going to see the producer price index come in. That's similar to CPI, but it's really what the producers are paying for their raw goods in order to make all the goods that we buy. And then on February 22nd, we've got the home sales report coming in. So each of these little bits of data coming in, if we see increases here that say that the economy is running hot or that inflation is running hot, I think we're going to see potential spikes in these bond yields. So what's my game plan here? Well, I think that one certainly should feel free to take advantage of this nice increase in bond yields that you've seen over the last 2 weeks. But again, not going all in, because I think there's a good potential that we see bond yields increasing even over the next few months. One of the big factors here, as I've mentioned before, I think is going to be rising US debt. And more, as I listen to various programs, I hear people starting to talk about rising US debt. In fact, just listening to CNN radio yesterday while I was listening, there was a former senator on there talking about the potential for the world to revolt when it comes to purchasing our debt because of their fears about us being able to repay our debt. That hasn't been an issue in the past, but as our debt continues to rise, I see us being just a few failed treasury auctions really away from massive problems. I hope this information was helpful for you. If it was, please give us a thumbs up, and until next time, enjoy your investing.